Welcome back to the Talking Hedge. I'm Josh Kincaid, Capital Markets Analyst and host of your Cannabis Business Podcast. Today we're going to take a look at the stock market, what's going on in the economy, as well as precious metals, gold and silver. Today's the last day of the second quarter and the best quarter in 22 years. I mean, you can feel it, right? Probably not. That's because a quarter of all personal income in the US now comes directly from the government. That's essentially helicopter money. 41% of business closures on Yelp have permanently closed as the V-shaped recovery implodes. Of the businesses that closed, 17% are restaurants, and 53% of those restaurant closures are indicated as permanent. The Atlanta Fed did a survey, so these charts are kind of showing the results of how they think that the economy is going to move forward. The result shows just how uncertain participants are about their own expectations. Here's an uncertainty index, which tracks the gap between each company's lowest and highest sales growth scenarios. So this spike in uncertainty is from a big hit in sales. People expected that June that there would be a rebound, that businesses would open, and when that didn't hit, now there's even a higher expectation of low sales. So unless visibility increases and uncertainty about their own expectations increases, it's going to be tough to plan and make long-term decisions with confidence. So with a quarter of all Americans getting handouts from the government and small businesses essentially collapsing, this bear market rally looks phenomenal, right? The stock market's doing great. But in fact, what you can see is the federal balance sheet going right in line, coupling with the S&P. And this rally can be directly correlated to the federal government's just printing out trillions of dollars, as the federal balance sheet is directly in line with the S&P. They're just using BlackRock as a proxy to buy bonds and equities in the market. So they're literally just propping it up. Take a look at the plunge protection team. They've been in place for a few decades. So this bear market rally actually might be one of the greatest rallies of all time, following 1929, 1938, and 1974. If you haven't heard the term "don't fight the Fed," it essentially means if the Fed is printing, you can't win. You can't bet against them. And so what you're seeing is some bears capitulating. So people that are betting against the market have to kind of give up that idea for the moment, as the Feds are just itching to print another $1 trillion as the market might correct again, another 20% drop. But nonetheless, you're seeing a massive short squeeze. In fact, the third biggest short squeeze in history. So what that means is when people are betting against the market and then they change their mind, they have to close their positions. And so by buying that short, it's going to temporarily kind of prop that market back up, making it look like a bounce. So NASDAQ's at an all-time high. People are buying bankrupt, hurt stock, you name it. Crazy stuff is happening. There's never been a bigger disconnect in prices and profit in the stock market. I've been screaming at the top of my lungs about the massive disparity between stock prices and fundamentals. It's more like fundamentals. There's a few analysts that are taking a look at maybe the biggest disconnect between prices and profits in at least 30 years. With profit margins in recent years becoming extremely inflated, it can serve to make stock prices over the past few years look less expensive than they otherwise would be. For example, stock prices today are more expensive than they were 20 years ago at the peak of the dot-com mania. It turns out that the current disconnect between stock prices and sustainable profits is in fact greater than anything we've seen in modern history. We don't have to go back that far. The last time we saw stock prices and earnings disconnect in such an extreme way was that lost decade from 2000 to 2010. With the dollar being backed by full faith and credit of the U.S. government, faith is waning and credit is debt. We have too much debt. So we're going to take a look at what that might mean. And in a moment, we'll take a look at how China might take advantage of that, why gold might even be that more important. The stock market disconnect is also a disconnect with individuals and businesses. So there is a 5-year average growth for wages and productivity and real economic growth that tells a true story. With the surge of the stock market over the last decade, it gave it an illusion of prosperity. But in fact, there's a wealth gap because the top 10% of income earners own 88% of the stock market. The bottom 90% own just 12%. We have a massive reliance on debt in this country. Unlike any other country, we can continue to print dollars because the US dollar is the world's currency. There's a demand. When countries borrow money, they borrow it in US dollars. And so it's an issue. The reliance, or what some are calling a credit-induced boom, it's reached an inevitable conclusion. The unsustainable credit source boom, which led to artificially stimulating borrowing and creating diminished investment opportunities, which can be seen in subprime mortgages in 2008, excessive share buybacks over the last few years. And even with the talking heads on CNBC, Bloomberg, and the government kind of chiming in about stock buybacks, companies are still doing it at all-time highs. With it makes no sense to me why you would invest for a company just to buy their stock back. They're supposed to have R&D and new products, so it's pretty wild. It doesn't make any sense. And if people were paying closer attention, they would notice that for every $4 that the government is printing, really only $1 of that goes towards economic growth. So it's incredibly wasteful. 75% gets wasted. So in the US, the Federal Reserve, they've been the catalyst behind every preceding financial event since they became active with monetary policy in the late 70s. Not surprisingly, after the market correction in March, the immediate response stopped the correction from becoming a full-fledged bear market. However, it only forestalled the inevitable, as we've seen a sharp rise in speculative fever ever since, like we mentioned about just buying bankrupt Hertz stock, for example, or Tesla over $1,000. As we reported before, Facebook and Amazon, Apple, Microsoft, and Google, they kind of account for the majority of the S&P. As those companies have appreciated 23%, the remaining 495 companies are down 8%. So, taking a look at historical bubbles all the way back to 1871, with the exception of 1929, 2000, and 2007, every other major market crash occurred with valuations at levels lower than they are currently. So, I mean, it's just a matter of time. The US dollar became the global reserve currency back in the early 70s with an agreement between Saudi Arabia to settle all oil worldwide in dollars. And so that's pretty much what's propped up the market. But China is forming an oil buying cartel to possibly end the petrodollar. You may have noticed that housing prices have gone up, but if you haven't asked why, you should. So if a house has doubled in the last few years, like a good friend of mine's house has went from 350 to 700,000 and she's done nothing to it, you have to ask yourself why. If you don't improve your house and it goes up in value, it might be because the purchasing power of your dollar is decreasing, which, newsflash, it has been for, over 75 years. So in 1950, you could buy a house for $7,000, and a house now is $400,000. I grew up in a little teeny house, 2 bedrooms. Walked by it the other day, and I saw, wow, it's $400,000. Like, I wouldn't pay more than 80 grand for that house. So it's not that housing is going up; the value of your dollar is going down. Gold is looking like more of a store of real value as it hits a record high in the second half of 2020. Although take that with a grain of salt because you're buying it with fiat dollars. So doesn't really matter. Gold is its own value. But looking at the best performing major assets in the past year, gold soared by a quarter. So here we can see quarter one performance of major asset classes. Crude, which we saw hit negative prices, which is insane. That's never done that before. It was at negative 67% by the end of the first quarter. Commodities and real estate all dropped, although I expect commercial real estate to absolutely plummet. The Dow was down negative 23%. NASDAQ's now at an all-time high. Gold, though, gold's always been positive this year. So when asking the question, why gold, why now, looking at your opportunities, the stock market has never been more overvalued. You have more IPOs that are losing money since the dot-com bubble. So with zombie companies that have higher debt obligations than revenue that are losing money, this is more speculative than I'm comfortable with, which is why precious metals look even better as trillions of dollars gets printed, as zombie companies file IPOs. I mean, that's not competition to gold, in my opinion. We've also showed this chart before, which shows fiat currency timelines. And with 100 years, we're kind of at the end of that historical trend dating all the way back to 1400. In fact, we can go back to 600 AD when China first implemented fiat currency. It's never worked. It's always reverted to its intrinsic value of zero. So it's just a matter of time. This is probably longer than it should have. I definitely think that this virus has extended the shelf life of the US dollar. China was definitely ready to be working with Russia on a gold-backed oil platform, gold-backed yuan, and they had the BRICS country, Brazil, Russia, India, China, South Africa, all on board with it. And then with the Silk Road, The opportunity that China had to expand into Southeast Asia has since kind of been tarnished with the US claiming that this virus came from China and therefore slowing things down. It's inevitable that the US dollar will decline. Who takes over, whether it's a standard drawing right, the SDR, or a gold backed currency from somebody else? I'm not really sure. I just know that historically speaking, the US dollar's fiat currency is over. I mean, they could save themselves with gold back again, but the fiat, it's dead. Looking at the purchasing power of gold in the US all the way back to 1800, it spiked to 1,000 right around the late 70s, early 80s. Maybe that was the savings and loan crisis. And then again in 2015. And a lot of people don't even realize that between 2011 and 2015 was incredibly shaky. But if you weren't watching it, you wouldn't know. Gold purchasing power, regardless of what currency it's in, has had a trending increase. Another way to show that is fiat currencies versus gold back to 1900, whether it's the dollar, the pound, the yen, all of them plummet. And here's another chart about gold's performance compared to other financial assets since 1971 or 99 or 2009. Doesn't really matter. Stocks tend to do fairly well. Gold is a nice stabilizer, though, always doing a fairly competitively against treasuries and commodities and other assets. Here's another chart about major asset classes. Emerging markets are down almost 10% for the year. Gold is up 16%. U.S. government bonds are up 20%, but that's at a massive discount. Velocity of money is plummeting. That's really the only thing keeping the US dollar relevant is how many times can you give that dollar and turn it over. So if you pay somebody something and they use that same dollar to buy something and they use that to pay something, that's the velocity of it. That's the only thing keeping the US dollar relevant. But on the flip side, silver prices are going up, and that's because the gold to silver ratio is fairly low, the lowest it's been in a long time. As gold prices were high and silver prices were low, probably artificially low, being suppressed, but nonetheless is starting to catch up. Not all gold is created equal. There's 83 tons of fake gold bars that were found in China, creating a counterfeiting scandal. So in what may be one of the biggest gold counterfeiting scandals in recent history, there was more than a dozen Chinese financial institutions, mostly trust companies. They loaned 20 billion yuan, which is $2.8 billion in the past 5 years, to a jewelry company as collateral. And yet there was just one problem. The gold turned out to be gold-plated copper. So one of the lenders that wanted to melt the gold collateral found some tungsten plate in the middle of the bars, setting off this whole issue. So the day after that counterfeit China gold story hit the market, gold futures started surging above $1,800 for the first time since 2011. So the news sent a panic into the market as people tried to buy as much physical gold as they could, which also could be a sign that the world is losing faith in the fiat currency system. With the US having one of the highest median incomes in the entire world, and yet just 50% share the population in middle class income households, so that would mean that the US is in the same category of a banana republic as Turkey, China, and Russia. So with the devaluation of your dollar, I would look at other forms to store your wealth. Maybe gold and silver is that for you. It is for me, but invest wisely. With that, we're going to roll this one up. I'm Josh Kincaid. This is the Talking Hedge. Don't forget to like, share, and subscribe, or don't, and I'm out. Don't forget to smash that like button on your way out and check out these other videos that we've got.